Hey, hello, and welcome everybody. I think we are live. Welcome to today's workshop. For those of you that don't know me, my name is Jason J. Hamilton, and I am a Charter Retirement Planning Counselor and the admin of this page and group. And every Sunday at 2 p.m. Pacific time, we're going to bring you a workshop to help you increase your knowledge so that you can retire with confidence. So I know there's a lot that goes into retirement, so we try to break it down in little pieces and little bite-sized bits so that you can slowly build your knowledge. And when it's time to make that move, you are more ready than you were before you watched all these workshops. So today, I think I have something really interesting to share with you. If you haven't heard, there's something called the Secure Act that has currently apparently passed Congress. Well, it passed through the House, I should say. So now it's moving on. And I wanted to talk to you today about some of the things that could be coming that may impact your retirement. So hopefully, I think you'll find this very interesting. And first of all, before I jump into that though, I want to say I hope you're all doing well, having a lovely Memorial Day weekend, and that everything is going smoothly, and maybe you have a little bit nicer weather than we have here outside in California. Fortunately, it's not really barbecue weather. It's about to rain here, and so I'm inside working on my workshop for you guys so that I can help you, again, retire with confidence. And so, hey, give me something to do to stay inside with, and so that's wonderful. But I want to welcome everybody to today's workshop. If you are, if this is your first time, I want to say welcome. I want to thank you so much for tuning in and watching. We try to bring you really good value, and really good insights to things that we're seeing around retirement that comes from the questions you ask, right? So if you have questions to ask, go ahead and ask them here on the page of the group. Ask them, and don't be shy that if you think you may be asking something that may be a silly question. That's not what it's about here. What it's about here is getting you good questions, or getting your questions answered with the most available information we have. But before you do, it's never a bad idea to do a search, right? You can search through because we get some of the same questions over and over. So definitely use the search function on the left side of the page here so that you can search through and see if questions have been asked before. But if you don't see the answer to your question, then go ahead and feel free to ask that right away, and we'll be happy to jump in and do our best to answer that for you. So today I want to talk about some things, like I said here, this Secure Act. Okay, the Secure Act is going to be something I think might be pretty darn impactful when it comes to your retirement. So we're going to talk about that, and hopefully everything's coming through clearly. If it's not, please let me know, but if it is, then that's great. I'm going to pull up this article here by my friend, Jamie Hopkins, a really smart guy. So let me share my screen with you here and make sure that looks like I'm in the bottom corner, so that's good. Okay, excellent. So I want to share this article by my friend Jamie here. So if you don't know Jamie, Jamie is the Director of Retirement Research at Carson Wealth. Met him just a couple weeks ago in person. Really smart guy, but he wrote this article. I think it's just better than I could write. So I figure why not just share what he wrote, because I think that's going to be better for you all. So this Secure Act, okay? So the Secure Act, what they're really trying to do is bring in some changes that they think will help people retire more confidently in a sense. Maybe they will, maybe they won't. There's some things in here that actually I'm a little bit concerned about. I'm trying to make this a little bigger. I'm a little bit concerned about that I don't know if are actually good things potentially. So I want to share some of the things they talked about, and then also share some concerns that I have, and maybe just to make you more aware of them, so that we can all be on the same page here. But if you didn't know, as it says here, the very first real movement of the year, it's called Setting Every Community Up for Retirement Enhancement Act, passed the House with a 417-3 vote on Thursday, and is expected to make its way through the Senate during this current term. So very high likelihood that this is going to go through, but there is something else called a Retirement Enhancement Securities Act. So there's some similar crossover here, but there are things that are different. But sometimes when these things happen, they do bring these type of things together and combine them and try to get the best of both worlds. And sometimes they mess that up too. We all know how it can be in Washington sometimes. But the big things I want to talk about are labeled here. And there's actually a couple things that are not listed in here that I think might actually be very interesting to share. So I also will share the kind of the short section by section act right from the House and Means Committee. So let's talk about these really quick. So the bill is supposed to go do some things for you, like smooth out some minor roadblocks to retirement, like removing the IRA age limitation. So right now you currently cannot contribute to an IRA after age 70 and a half. So you can contribute to your 401k if you're still working past that age, but you cannot contribute to your IRA when you're contributing past that age. So they want to do that. So remove that IRA limitation, the age limitation. Expand the start date for RMDs. Okay, so what that means is currently RMDs are at 70 and a half, where you have to start drawing from those accounts even if you don't need the money. They wanted the first what they were saying about 72, and then Jamie's mentioning here about 75. So this continues to get pushed back. Increasing annuity options. Okay, so that means leaving annuities that may be in there if you have like a 403b or 457 plan instead of a 401k. Those are very common in those. They're not very common in 401ks because meeting a fiduciary standard with a annuity is very difficult to do. And then potentially increasing the likelihood of small employers starting retirement plans. So they're going to give some incentives here to try to get retirement plans more available for folks that work for small employers. Okay, so I'm a small business owner myself, and I am in the process of hiring some people right now, but really thinking about what type of retirement plan to offer. If you want to offer a 401k, it can be prohibitive. It can be really expensive to do that depending on how you're going to do it. But there are plans like simple IRAs and things like that that still have good contribution limits, but they're not quite as good as like a 401k. But it is tough, when you're a small business owner. It's just expensive, and honestly, it may be prohibitive in cost to actually offer these plans when it comes to this, comparing this to other benefits you can offer your employees. So, so like it says here, there are a strong argument these changes, while positive, won't move the retirement security needle much or at all. So, really, this may not change anything for a lot of you, because if you think about it, allowing you to continue to contribute past 70 and a half, even if you're working, what are they saying, right? That maybe you should be working beyond 70 and a half. And I know a lot of folks here don't want to do that. They want to retire early. So this may not benefit you that much. But the other thing that is interesting is that many of the changes can only be viewed as benefiting wealthy IRA owners that don't need the RMDs yet, and a clear nod to the product manufacturing lobby. Okay, so product manufacturing like annuities and things like that. So there's a huge lobby for that. They're really the reason why the fiduciary rule fell apart. And now they're trying to replace it with something called Reg BI, so Regulation Best Interest, which the fiduciary community just laughs at. They just think it's a joke. The SEC is trying to push this through as being as strong or stronger than the fiduciary rule. But all fiduciary advocates, I'm not going to say, I shouldn't say all, but the majority, the high majority, see this Regulation BI as kind of a joke. And that's why you see states bringing in their own fiduciary rules. Nevada is one of them, I believe. Massachusetts is one of them, and I can't remember if New Jersey is another one. But there's a huge pushback from these insurance lobbies to push against this, because when you have to really do something in a client's best interest, and there's a legal standard and there's repercussions, when it comes to selling annuities or insurance products in general, it's pretty tough, right? And so we have the CFP board that's going to be they've already released their fiduciary rule. They're supposed to go into effect in October of this year. So we may already see a bunch of people using the CFP designation that work for the large broker-dealers, having to make a choice between sticking with fiduciary or staying with a large broker-dealer. So we'll get more news on that as that comes up towards October. But for right now, this is really what we're looking at here. So as I mentioned here, some of the major issues facing retirement security for most Americans will still come from Social Security funding issues. As you know, 2034 and later, there's supposed to be a projected shortage of Social Security, and they're saying about 70 to 80%. I think 78% is the last I saw of the current payout is supposed to be there, but you may lose 20% or more of your payment if there's no changes made. The changes I think are pretty simple to fix, but obviously raising taxes doesn't really go sit well with a lot of people. But if they raised the Social Security tax from the employee side right now 6.2% to about 8.2% or 8%, that would pretty much fix it. They could delay full retirement age, or they can reduce benefits. There's multiple things they're looking at there. I really don't think it's going to get reduced because so many people rely on Social Security as their only source of income, but it is something to take into consideration. So when I am doing retirement plans for my clients, I will run a stress test on Social Security specifically and say, hey, what will happen to your retirement plan if your Social Security payment is reduced by 20 or 30%? And we're going to build that into your plan to make sure you know what to do and how to approach that. But I think a bigger concern for me is the strains on Medicare, right? I think that's a bigger concern, to be honest. So again, that's a whole separate issue. But here, there's some things I want to cover with you. Like I said, 8 of them in this article. And then I want to share a couple more things that I think are applicable maybe to some folks here. So number 1 is to increase small employer access to retirement, okay? So like it says, the goal here is to try to expand small employers' capability to offer some form of retirement savings to employees. I know a lot of people, like, here's the reality, right? A lot of people say they don't save for retirement because they don't have a retirement plan at work. And honestly, I hate to say it, and this is kind of tough, right? So you might get real upset with me for saying this, but you don't have to have a retirement plan at work to save for retirement, okay? It's nice because if your employer offers a 401k and you can get a match, so let's say you contribute 5% and the employer matches 5%, well, that's free money, and that really helps. But I don't think it's really an excuse to not save for retirement because you don't have a retirement plan at work. There are something called an IRA or a Roth IRA, which stands for Individual Retirement Arrangement, and you can fund those if you are below 50. You can put up to $6,000 per year and up to an additional $1,000 per year if you're 50 or older as a catch-up. Not saying that's enough, but because that's probably not enough to save. But you can also save for retirement in taxable accounts as well. So again, saving for retirement is really an individual responsibility. This act that they're trying to pass is going to make it a little bit easier. But at the end of the day, we have to take responsibility for ourselves when it comes to saving and planning for our future, okay? So I just think a lot of this gets pushed off, saying because you don't have a retirement plan at work that, you don't save anything. And I just think that's unreasonable. But the second thing here is to increase the annuity options, okay? So this section 204, as it says here, seeks to update the safe harbor provision for plan sponsors to select annuity providers in order to offer in-plan annuities inside of a 401k. So many 401ks stay away from annuities, right? So why do you think that is? This says here in part because of concerns about liability and picking an annuity provider for the plan. In my opinion, the reason is because 401ks fall under what are so-called ERISA standards, right? So that's a fiduciary standard. So what does that tell you? If you have a fiduciary standard, it's a very high legal standard, and that's why 401k plans in general have gone down in their fees. Many plan fiduciaries are required to review the funds inside their plan every few years. Many of them don't, and that's why there's a huge field of lawsuits coming after 401k providers when they have small business providers generally, because the big companies are aware of this. But you have to make sure that everything you're offering in a 401k plan is really some of the best out there. And I'm seeing better and better 401k options, so that is happening. But, annuities inside 401k plans are not very common. They are very common inside of 403b plans, and 403bs are generally had by, say, churches, schools, hospitals, and most of them do not have an ERISA fiduciary standard attached to them. So that's why if you're a teacher, and teachers in general, you'll see just teams and like 20, 30 companies coming in to offer all their different plans when they go into schools. And so then you as a teacher are left to try to figure out what's really going on for yourself. And then what I'm seeing in most cases is most teachers aren't equipped for this, right? Most teachers are not equipped to make good decisions around what is a good 403b option and what isn't. And that's why most of them have a bunch of expensive annuities with high surrender fees and all kinds of other problems that just really would be taken care of if they had a fiduciary standard like the 401k. So these new rules here would ease this liability concern to some degree and potentially opening up the path for more annuities to be offered inside of retirement plans. So here that I'm not 100% anti-annuity, but I do think they're oversold, and I do think people put too much of their retirement savings into an annuity. I do think purchasing a portion, with your retirement assets, if you're a very low risk profile, could be a good idea. Or if you have a good chance of running out of money, like if you do your retirement plan and it looks like if you live to 90 or 95, you could have a real significant chance of running out of money, then I definitely think you might want to consider getting some sort of annuity because that will alleviate some of that. But for most folks that have a good chunk of retirement savings I heard somebody the other day I was speaking to that has about $1 million saying that someone was recommending they put 2/3 of their monies into annuities. I just think that's a little bit extreme for most people. Again, this particular person was comfortable with owning some investments, and locking all that money up in an annuity, I just think is probably too high. But having a little bit of this availability in there might be okay, right? Okay, so the next thing here I want to talk about is increased required minimum distribution ages, okay? So the Secure Act is looking to delay this requirement to 72, but I don't know if you want to call that RESA, excuse me, RESA Act, the RESA Act, currently in front of the Senate, seeks to push RMD requirements even further back to age 75, okay? So this sounds good. This sounds good up front, but there's some problems, and I'm going to talk to you about that. Shortly. So there's one criticism of the provision that it mostly benefits those with significant tax-deferred savings by allowing them to grow this money even longer. So if you look at the overall positioning of Americans when it comes to retirement, it's not good, right? So most people are going to have to take their money out before the RMD rules kick in. And if you don't know what RMD stands for, it's required minimum distributions. And so currently at age 70 and a half and older, there's a percentage that you have to take out every single year from your pre-tax accounts like 401ks and IRAs. The first year is about 3.76%, call it 4% to make it even, and then it goes up from there. And the idea is that you exhaust that money so that the IRS gets their taxes on that money that you deferred all these years by the time you pass away. So the problem that is currently happening is most of my clients are generally between, say, like 53 and 67, for example, right? That's kind of the majority. They have parents, though, that are in their mid-80s. And so what's going on in their mid-80s is generally spending has slowed down, income need has gone down, their Social Security has gone up, and so they don't need a whole lot of money from their retirement account. So ideally, they would like to preserve some of that in a tax-deferred manner, either for spending later or really to gift to their legacy recipients, right, to their heirs. Well, what's happening in their mid-80s is these RMDs are kicking in, and a big chunk of money's coming out, and it's all taxable, number one. And then they don't need that money, so then they're taking that money, so they're paying taxes on that money, so they're frustrated at that. And then number two, they don't know what to do with the money, so they reinvest it in a taxable account, and now they're paying capital gains taxes on all of that money each year. So it's just taxes on taxes. And so for a lot of folks, delaying this seems like it's going to be a good idea, but I'm going to talk to you about why it may not be so good down the road. But hey, it might be good if you're going to continue to work, because if you're working at 70 and a half and you currently have IRA money, that money has to come out. So if you're earning an income plus IRA money's coming out, that money's coming out at their top marginal tax bracket. So that can really be painful for folks that are still working in their early 70s. So delaying this to 72 or 75 can potentially allow you to work longer and not have to face this. But again, there's some things that I think are not going to play well for most people. One other suggested change here is the RMD rules have been included, allowing smaller accounts, such as those under $100,000, to be exempt for withdrawal requirements for the owner of the account. Okay, that's for the owner, and this is important. We'll talk about that in a minute. But I think that's great, because a lot of folks that only have $100,000 or less, generally they're really trying to just make it on Social Security. That's the reality, and that's just what it is. So if they can make it on Social Security, usually this $100,000 is their sort of like large emergency fund, or to cover extra medical expenses that they have to cover above and beyond Medicare, or potentially for long-term care in the future. So I think this would be great if they did that. I wish they'd raise it up a little higher, actually, because I don't think $100,000 is a lot of money when it comes to retirement. So if they raise it to $200,000 to $250,000, I think that would be great, but that's currently what is proposed. Okay. All right, this one I think could be good. Removal of age limitation on IRA contributions. So for years, there's been a rule that essentially discouraged retirement savings and IRAs for people who continue to work later in life. So after age 70 and a half, you can no longer contribute to an IRA, but amazingly, you can still contribute to a Roth IRA. So Section 114 of the Secure Act would remove this savings limitation by repealing the age limitation for traditional IRA contributions. I think this can be great, because a lot of folks have, let's say, an older spouse that may be over this age, but they have a younger spouse that's continuing to work. Or what I also think is going to be happening is we're going to see a lot of people shift from their requirement job, right? So they had to work this job to retire, to sort of an encore career, right? I see this is probably going to happen a lot. So where a lot of folks end up starting a small business, or they do something in retirement to earn some income just because they enjoy doing it and they don't want to sit around all day doing nothing. So I think a lot of people will benefit from this if this goes through, because hey, how wonderful would it be if you continued to work and maybe had a small business, or maybe had some rental properties that you were the property manager of, that you created a property management company, and you can call that earned income, and you could continue to earn income. And if you don't need this money, continue to stuff this away either on a pre-tax basis if you're in a high tax bracket, or again, you utilize a Roth IRA. But the Secure Act would remove the savings limitation by repealing the age limitation for traditional IRA contributions as well. So I think that would be great. Nothing wrong with that at all. I think that would be wonderful. Number 5 here is Section 106. So it's tax credit for automatic enrollment. So this introduces a new tax credit of $500 to help some smaller employers encourage automatic enrollment into their retirement plan. So I don't know how you guys feel about this, but I think it's a good idea, because if you're automatically enrolled into an IRA, the most successful savers in life generally have automatic, contributions taken out of their account. This is why 401k millionaires are so popular, is because people just chose a percentage and they picked, say, 10% or 15%, for example, and they just took out that money and invested their whole working career, and then somehow 20 or 30 years later, they end up with some money. So automatic enrollment, I think, could be very, very powerful, because from a financial planner's perspective, right? From a financial planner's perspective, human behavior is probably the #1 inhibitor of financial success. It's not the amount you earn, generally. Some people it is, okay, so don't kill me on that comment. But for most people, it's financial behavior and behavior management that keeps them from saving and investing money over the long term. So if the money is automatically taken out because you have an automatic enrollment, and I would love to see this start from day one, because a lot of people can't contribute for a year to their retirement plans, like a 401k. So what ends up happening is they get used to living on a certain income, and so then when it comes to the year they can qualify the following year, they're already used to living on that extra 10 or 15%, where if they would have started from day one, that would have been a whole lot better. The challenge is, from the employer perspective, at least this is my opinion, okay? I don't know if it's fact, but my opinion is there's turnover, right? So a lot of people aren't going to make it to the first year. So if they have to pay their, what's it called, TPA, I forget the name of it, but whoever manages the 401k records, essentially, if they have to have every employee that's ever worked there for 2 weeks, a month, 30, 60 days, whatever it may be, and they have to manage the records for that, that can be painful and be very expensive. So I see why they want to wait a year, but from an employee perspective, starting day one, I think that could be really great. Okay. This one here, I think this is wonderful for young families. Okay, this doesn't apply too much to folks here generally, but it could apply to your children or even your grandchildren. Penalty-free distributions for birth of child or adoption. Okay, so a really interesting welcome addition, I think I agree with this, is going to be a new exemption of 10% penalty tax of 72T for early withdrawals from retirement accounts. So this would allow an aggregate amount of $5,000 to be distributed from a retirement plan without the 10% penalty in the event of a qualified birth or adoption. So the distribution we need to occur within 1 year of the adoption becoming final or the child being born. Not a huge amount of money. $5,000 is not even close probably to what you need for an adoption. My most recent research said about $30,000 or so is the average you're going to pay for an adoption all in. But it's something, right? It's something. And to remove that 10% penalty, that's a good move. So that's a good move, moving the ball down the field there. And then for birth, again, my recent research says it's about $7,500 or so to cover a birth. So getting $5,000 out without penalty, that could be great for people. Nothing wrong with it. I don't see anything wrong with this at all. I think this is going to be great. So here, number 7, lifetime income disclosure for defined contribution plans. This bill would require that the defined contribution plans deliver a lifetime income disclosure to participants once every 12 months. This lifetime income disclosure would essentially show how much income the lump sum balance in the retirement account could generate. So essentially, if you put this lump sum money into an annuity product or a pension, same thing. A pension is really just an annuity at the end of the day. It shows you how much it can generate. Okay. So the methodology for calculating lifetime income is still in the works. So here is where potential problems may come. If you're in certain states like Illinois, California is going to have problems with this. I don't study all the states, but there's a lot of states that have pensions that have promised too high on their income options, and so they're going to go bankrupt at some point. So we're seeing this already. You have places in Illinois where the pensions are funded like 40% or 42%. They're going to go bust at some point. In California, no one's talking about this, but they really should be. Okay? Not all cities, but there's a lot of cities here, including some big cities, that are going to be facing potential bankruptcy because they overpromised on their pension payouts. And nobody wants to deal with it. Okay? Nobody wants to deal with this because they don't want to be the bad guy. But what I'm predicting, from based on the research that I'm seeing, is that teachers that are starting today, so teachers that may be in their 20s or 30s, that are hoping to get paid out in California on this pension income system here, have some real serious potential of bankruptcy and them not getting paid from their pension. So really scary stuff, but again, this is what concerns me about this is that the methodology for calculating lifetime income is still in the works. So if they overpromise on this, this could be a problem down the road. But again, I'm sure they would address it on a year-to-year basis. But that's something that may be good. I don't know. We'll see about that one. Okay, here is a huge problem. This number 8. Okay, this is where you should really pay attention. If you are close to retirement, this is going to be a big deal. Okay, the Secure Act would make significant changes to the inherited retirement plans like 401ks, traditional IRAs, and Roth IRAs. So in the past, beneficiaries of these accounts could typically spread the distributions over their own life expectancy. Okay, this was not a bad thing, at least I'm talking about from a consumer perspective. I'm not talking about from a government IRS tax perspective. I'm talking about from you, the consumer, who I care about, because generally you're my client and I want to help you. This is going to change, and this could potentially change, I should say. So the new bill, however, includes what is viewed as a tax-generating provision that would require most beneficiaries to distribute the account over a 10-year period. Okay? Think about that. If you are a beneficiary to one of these accounts, this could potentially require you to distribute this account over a 10-year period. So this would accelerate the depletion of inherited accounts for many large IRAs and retirement plans. So this could be really bad. Okay? This could be really bad for folks that are the recipients of these inherited IRAs. So typically smaller inherited IRAs are liquidated fairly quickly by beneficiaries already. A lot of folks, if they get a $5,000, $10,000, or $20,000 IRA inherited, they usually use that for something like, a down payment on a house, or they just use it for a vacation. Not a big deal. But like it says here, the end of the so-called stretch IRA or retirement account makes a lot of sense from a public policy perspective, especially after the Supreme Court has ruled that inherited accounts are not retirement accounts. So if you haven't heard this, the Supreme Court ruled that inherited accounts are not retirement accounts, so they don't qualify for the same protections, like from lawsuits and things like that, that retirement accounts do. So as it says here, as such, it does not make policy sense to allow for an extended tax benefit through the beneficiary's retirement. The RESA bill has a significantly different provision, which would also end the stretch provision, but for larger accounts over $450,000. So for most people, they're not going to be affected by this, but for those of you that have high amounts of assets, this could definitely impact you. The potential tax burdens of faster distributions of inherited retirement accounts will increase the need for proper estate planning and potentially more strategic Roth conversions during the life of the account owner, adding additional complexity to retirement and estate planning. So think about it like this. If you have your RMDs accelerated in these pre-tax accounts and they're not in a Roth account, you can be potentially paying a lot more taxes a lot earlier on. So if you've been around and hang around here for a while, we've talked about strategic Roth conversions where you convert portions of your pre-tax account over to a Roth account, which will then go around the RMD requirement. I don't know if this is going to, it says here about Roth IRAs, so this is for inherited though, but if you're going to increase the distribution requirement of your IRAs, that could potentially be a lot more taxes early on. So really considering whether doing some partial Roth conversions, especially before you activate your Social Security benefit, because that gives you the ability to get a whole lot more over to the Roth section or the Roth account, that could be very, very beneficial for you, but like it says here, it does add additional complexity. So I would not recommend doing this on your own because you don't want to mess this up. If you make a mistake here, it could be potentially a big tax burden down the road, so you really want to work with a professional on this. And I think, I think this summarizes this article pretty well. But if you have questions, go ahead and drop them in the comments. We'll talk about those. But there's a couple other things here I want to talk about before we wrap up. So this is kind of a summary here that I got from the House Committee on Ways and Means about this, the Secure Act here. There's some other things here I think are going to be important. We talked about a lot of this already. We talked about these first few here. So this will be interesting here for non-tuition fellowship and stipend payments as compensation for IRA purposes. So if you have children that are doing a fellowship of some sort, like maybe they're a graduate or a postdoctoral student, currently the stipends and non-tuition fellowship payments they received are not treated as compensation and cannot be used as a basis for IRA contributions. The new legislation would remove this obstacle to retirement savings, and they'll say that these amounts are includable in income into account for IRA contribution purposes. So if you're studying for a doctoral degree, for example, you're probably getting paid by the school on fellowship or non-tuition payments maybe into your 30s. So if you're waiting to your 30s to get started on tax advantage payments to your retirement accounts, that could be really late, right? So by this change here, this would allow the graduate and postdoctoral students to contribute there. I think that would be wonderful. Like it says here, repeal the maximum age for traditional IRA contributions. We talked about that. Here's something interesting. This will have qualified employer plans prohibited from making loans through credit cards and other similar arrangements. What they're trying to do is essentially ensure that plan loans are not used for routine or small purchases, thereby preserving retirement savings. So many people take loans from their 401ks, and what they don't realize is when you take a loan from your 401k, people think, oh, it's okay, I'm going to get 3 or 4% paid back to myself, so it's a good thing. Well, here's what the problem that you're missing there is that when you take a 401k loan, not only are you paying that money back with after-tax dollars, so you take the loan out, you use the loan for whatever you want to use it for, house down payment, car down payment, whatever. Well, then when you pay it back each month, that's coming from your post-tax dollars that are coming out of your paycheck today, right? So you're putting that money back in, you're paying with post-tax dollars, and then again in retirement, when you take the money out in the future, you're going to have to pay taxes on that money again. So you're essentially getting taxed twice on it. So I actually think this is a good idea from a human behavior perspective. But hey, you know what? Sometimes it does give you a little bit less control over what you want to do with your money. So I think there's two sides to this argument here that need to be considered. These things we talked about a little bit here. These things we talked about here. There's another one here that I think is important. So let's talk about, okay. Is it this one? No, it's down here. I'm sorry. One more thing down here I want to share with you guys because maybe some of you actually participate in this. Where is it? I don't know where it's at. I can't find it here. There's something in here that would allow people that are getting paid from the government basically to give care for other people that normally it is. Okay. Maybe this is it. Okay, yeah, here it is. So many home healthcare workers do not have taxable income because their only compensation comes from their difficulty of care payments, which are exempt from taxation under Code Section 131. So because these workers don't have taxable income, they cannot save for retirement in a defined contribution plan or an IRA. So this provision would allow home healthcare workers to contribute to a plan or IRA by amending Code Sections 415C and 4080 to provide tax-exempt difficulty of care payments are treated as compensation for purposes of calculating contribution limits to defined contribution plans and IRAs. So that wasn't talked about in the other article, so I think this may be good because I know there's a lot of older folks that are doing care, you know, they're doing home health care as their job because they can do it maybe 4 hours a day or 6 hours a day. And that money, I guess, currently is exempt from, taxation, so they can't use it for contributions to these plans. So I think this will be another good benefit there as well. So that's what I wanted to share with you today. I'm going to take a look for questions here. Hopefully you found this useful. And if you are thinking about something like, hey, what's going to happen if these retirement account, these RMDs get accelerated and everything has to be paid out in 10 years, and you want to discuss what it would look like and if there's a tax benefit for you to potentially consider some partial Roth conversions, I'm going to put up my site here. You can go to keepitsimplefinancial.com/talk. We can definitely calculate that for you, right? So something we do for pretty much every client is look at, hey, does it make sense, especially if you're retiring early, if you're retiring at maybe like, before 63, 64, 65, before that range, and you're considering delaying Social Security a little bit to get a bigger benefit, there's an opportunity in that window that you can potentially move some money from pre-tax to tax-free at a very low tax bracket, pay a little bit of taxes today, but then that money is forever growing tax-free, and it's exempt from RMDs currently. So we can definitely help you with that. And if you want to talk about that, then I'd be open to discussing that with you on a complimentary call. So see if there's any questions here, and if not, we'll wrap up for today and let you guys enjoy your holiday. So there's a comment here that says, sounds like the Secure Act tried to give everyone something. The one we will benefit from, extending the start date for RMDs, even for just a year or two, will help IRAs last a year or two longer. That's a good thing. So I agree, but if they do extend it, you have to remember that they may actually be accelerating the amount you pay taxes on. So it may sound good, but if you pay taxes at a higher bracket forever, because the money's coming out faster, then that may actually hurt you in the long term. But if you're going to continue working, then that definitely would definitely help out. So that's all I'm seeing for questions today. So again, if you need help, guys, go ahead and go to keepitsimplefinancial.com/talk, and I'll be happy to schedule an appointment with you there. You can find my calendar and what available appointments there are. So I'm going to be very limited here on new clients after June, because I am going on a little vacation in August. So if you're interested in getting some help with this stuff and discussing your retirement situation, I highly recommend that you reschedule a call earlier than later. And other than that, that's pretty much what I have for you guys. I hope you have a wonderful Memorial weekend. You ate some great barbecue, and I will see you soon, and I'll see you around the page here in the group. Have a great afternoon. Bye-bye now.